great banker, Scott Hancock. Scott was Centennial Bank, 15 or so $billion bank, and he runs this region and good communicator, gets right to the point. He'll help us understand where PPP is, might even comment on how the portfolio looks relative to the region, you know, what's doing okay and where does he see concerns possibly, if there is any. He's okay sharing that, but share with us, Scott, what's going on with PPP and the region's economy, if you don't mind.
Yeah, I appreciate it. Thanks, Tim. And I definitely won't be. I heard Joe Thompson make some comment about hairstyles changing and stuff like that. As you guys can see, mine won't. But I'll try to share my screen here a little bit and Diane, make sure I do this right. So I'm going to start this slideshow and let's go here. So if you haven't been paying attention to Dr. Thompson, is I'll go ahead and finish his speech, is get your vaccine.
There you go.
It's important. It's not only important from the medical side, but it's also important from just the overall economy. Today, well, so what do you guys see here? A lot of people see a beautiful sunset, but where we are in the economy, I mean, this is a wonderful sunset, but you can also pinpoint on the cushions that are turned over, beautiful pool. This picture was taken, I think, at 28 degrees. So where's our perspective? Are we going to focus on 28 degrees, or are we going to focus on the beautiful sunset and the hammock park in the back and the fountain, et cetera? So I think that's where a little bit of baseline on where our focus is and what we want to pinpoint. We want to pinpoint the positives or the negatives. A few of the items I'll hit on today, and I apologize that my slides aren't near the quality of Dr. Joe's, but we'll get there. PPP and stimulus, the value, as well as the concern of some low rates, buying power, again, with low rates, and then where do I see our future? And this is all Scott Hancock, not necessarily Centennial Bank. I'm not an economist. I lived with an economist when I was at SMU, and I told him if you didn't like the information, all you did was change the graph. You either extended the axes or you moved the X and Y and made the pictures look a little bit different. So I think as we jump here, we have to know 900 billion, which is now, as legislation changes, and that's arguably 2 trillion that we're going, but how far does that go? If you lay 100 dollar bills end to end, 900 billion can circle there 35 times.
Is that right?
Government, it has really, it can also, if you lay it side by side, it covers the state of Arkansas multiple times. So it is a lot of money that's out there in the economy. And the thing about it we have to realize is we left a really strong economy. People were having banner years coming into January and February, and even into March of 2020. Multiple years, we've heard numerous discussions, and even on this call, numerous discussions of we're 12 years into a 10-year recovery, whatever the case may be. Through 2019, our overall economy was doing incredibly well. The stimulus plan has buffered some things, buffered some unemployment. We ended 2019 at 3.5%. Just some of the recent data, we're at 6.7%. Should that 6.7% really be 10%? We don't know yet. So that's where I look at, jump into the future, is what does the future look like? You know, the economy, we had stimulus checks. We're now looking at our third round. Again, I need to set politics to the side, because every session has got change going on. Every time they're meeting in Washington, D.C., they're, you know, as outgoing presidents, or in election years, the economy, the first 100 days, the economy, all these things are changing as they continue to meet. So a lot of this stuff is I need to be updating my charts almost hourly versus daily or even weekly. But stimulus checks hit the market. Unemployment benefits hit the market. PPP funds for small businesses hit the market. There's rental assistance program. So really, how far does the money go? Not necessarily too far, and is it far enough? Because when the other thing that has happened is the Fed has kept rates down. So as we jump into PPP here, and many of you know this, and this is a little hard. I tried to blow it up a little bit, but a little hard to read. But basically round one was everybody less than a certain number of employees. It tried to keep 300 employees, tried to keep the small businesses, but were able to qualify for round one. Everybody rushed to it. When they announced it, we had numerous calls. Everybody was in a panic. Oh, how many can we do? What can I do? How much can I get? I'm prepared. I've uploaded this paper application. I've done it. After about 5 times, I had one client that we finally said, if you'll wait on the link, it'll be a whole lot easier. But everybody was nervous. Everybody was anxious. The other thing is most of those people were now at home for a few weeks, a couple of weeks, and they're worried about their business even staying alive. Fast forward to round 2, we have a few vaccines that have come out. We have a lot of people that either got COVID or were definitely affected by COVID, so they're cautioned, so they're not running to the office as much, but businesses are back open in some shape or form. So round 2 has not been the mad rush, even though we as Centennial sent out 3,000 links in the first 18 hours. The first round, we did about $850 million and 8,500 applications. So you can see a typical application was about $100,000. Second round, we sent out about half of those, and about half of those, so 25%, have already come back and made it somewhere through the pipeline. So it's less, I guess, robust, but we're starting to see some of our markets, primarily Florida right now, that they're starting to tick up a little bit in their participation. It was just the people they learned, as I know the rules are going to change. There's no reason to do a paper application, and I know it's going to be automated, and I know SBA is not going to run out of money, or at least I have a high level of confidence that the SBA is not going to run out of money. So there wasn't that everybody, as soon as the portal opened up, we didn't try to crash it. But round 2, different than round 1, it's really based on revenue reduction. I will say, sadly, as an anecdote, is we had one customer that I approved their internal, there's multiple steps through the process. I won't get in those weeds, but I improved their internal Q1 over Q1 year over year, and they were down 91.66%. The qualification for round 2 is the same typical qualifications, except for you have to have used your round 1. You don't have to have it forgiven. Your business less than 300 employees. The loan doesn't exceed 2.5 million. And then the 2 changes are for those businesses that were deemed most effective, they can, and it's controlled by NIC code 72, but primarily hospitality and food services, they can apply for 3.5 times their average monthly payroll. You can use 2019 or 2020 if there's by chance you had a greater payroll, even though you had 25% revenue reduction. Your loan amount is based on 2.5 times or 3.5 times your average monthly payroll, like I said, for 19 or 20. But the qualification piece that was added, it's down in the bottom section of this, is if you were in business all of 2019, your gross receipts, and this is, some people have thought, oh, it's my net income, it's this, it's that. It's basically gross receipts, and we have some that have already made it through and back approved and actually obtained their money, so we know it works, is 25% reduction from a comparable quarter of 2019. So basically, real simple math is if you made $100,000 in Q1 of 19 and you made less than $75,000 gross revenue in Q1 of 2020, you qualify if you meet all the other requirements. So that's how you qualify there. There's a lot of money that's going into the economy through that. There's a lot of businesses that will be able to sustain. Personally, somebody said, who's been most effective? And I will say, obviously, restaurants have been affected. Medical has been affected because they're taking on some things, but they're having to adjust. How do they take care of their patients, and how do they see people and also how, televisits were not very prevalent just 5 years ago, and now they're all over the place. So, but theaters. The other thing I will say, and I'll get here a little bit on my soapbox, is I hear all the time, hey, I got online and I saw mortgage rates, or I saw loan rates, et cetera, so on. And I won't name any particular online companies, but how many online people are on this call? How many of them do you go to church with? How many of them do you sit next to at a sporting event? How many of them are your children's friends or your parents' friends? None of them. I'll just go ahead and go blank. Nobody in here knows anybody from blank mortgage ... online, or bank so-and-so online, where you get car loans or whatever. Is we have to figure out a way to shop local. We have to figure out a way, because those are the people, when you come to Centennial Bank or any other bank, and we've got a great banking community, when you come to us, you are supporting the people that are turning right back around and buying pizza or going to the local hospitals or whatever. So there's my soapbox, Tim. I'll get off of that. But
Hey,
we have to buy local.
that's good. I like that. All of it. That's good stuff, Scott. Thank you very much. Just did I hear you say, is that GDP you were calling was 3+%, and then it went to 6? It went to 6 something.
Unemployment.
Okay.
Yeah.
All right.
So,
yeah.
and there's a couple different unemployment variables, but I think they call it that the U3, which is pretty much, it doesn't take into the discouraged, and which is called U6, but U3, the typical reported unemployment, we ended as a nation at 3.5%, and everybody can look at that and see different variables. There's an argument, Northwest Arkansas ended in the high 2s, and I joke is there's a study several years ago that 3.2% of the population is not employable. So if we're at 2.8, that means the local people, and nobody raised their hand on here, the local people we're employing people, 0.4 people that should not even have a job. That's how robust our economy was. But that also led to, and Tim, you and I have talked about it, it's hard to get good people because they can go down the street for 50 cents more an hour, $1 more an hour, absent of the change in the minimum wage.
Mm-hmm. Yeah, exactly.
As I jump into the effects of rates and buying power, is you look at this and you can see what prime rate, Wall Street Journal prime, 75% of the largest banks in the nation, that's what follows. So if you go back to the 80s, you can see, it got up north of 20%. But if you look down here and following our latest recession on the far right of this, you see a flat line. I'm sorry, it's a straight line. It's not a flat line. We weren't quite dead, but that was following our recession. It was at 3.25. And then if you see the increase, a little stair step increase, it took 3 years for us to increase from 3.25 to 5.5. And if you look at that 5.5 compared to the rest of the graph all the way back to 1955, it's below probably 80% of prime for the history that we've tracked it. We're going back 50 plus years, 60 plus years, but it took 9 months to drop back down. And so what has that done? Rates, interest rates, we have short-term rates, and I put this in the category of short-term rates. But what has that done? What's the buying power? So let's just take this example. You have $1 million commercial loan. Around here, we primarily base things off of prime. There's LIBOR used, it's going to phase out. But if you have a 5% $1 million commercial loan, your payment's going to be roughly $6,600. Over the life of the loan, if you have a 20-year loan, you're going to pay $583,000 in interest. If you have a 4% loan, you can see that the interest accrual would drop about $140,000. That's a 20% reduction in your rate from 5% to 4%, and it's a 10% reduction in monthly payment. What happens? People go, oh, that's great. $6,600, shorten my amortization. No, I'll pay $6,000 and keep it at 20 years. No. They go, how much more could I borrow if I got a lower rate? In this scenario, you could borrow $89,000 more. So you could borrow $1,089,000. So let's go back to that $1 million loan. At the end of 5 years, you would owe $819,000. I'm not going to go back to the graph, but everybody can see the graph of what the prime rate did. So at the end of 5 years, if interest rates just climbed 2%, payments would be a 15% increase. Are we prepared? Usually the answer is yes. The competitiveness of the banking environment, other avenues that you can do. But this is where, from a banking standpoint, a lot of people talking to, oh, well, my payment's going to be this, I'll do this. You can't go to your tenant, if this is a commercial building, you can't necessarily go to your tenant and go, hey, my payment's going up 15%. I've got to go up 15% on your rate. That's when you lose a tenant, or you already have a fixed contract. That's the other thing is prepayment penalties, et cetera, in the banking world are driven by competitiveness. And so the reason I answer is yes, is because there have always been stimulus plans or rate cuts, or the economy is doing so well, the leases are up, the income, if it's a commercial loan, the income of the company is up, and they absorb it in over time and continue to be successful. Or banks have customarily stair-stepped this up, helped, or they've refinanced at another bank. And at this time, we are seeing it again following the last 10 years of a very strong economy. Is now you're seeing a little more loyalty back to banks. You're seeing a little more people come back locally because they need that banker that can sit across the desk for a loan or talk to them or be prepared and help them through some of these times where the dollar is not necessarily the commodity on the loans.
Mm-hmm.
I'll jump here. Again, this is a very, reason I put this many years out there, nearly 50 years out there, is because I think it just shows how strong of economy. And then, Tim, you asked a question, is what's keeping us so robust? I think we saw in 19 and 20, a lot of homes being constructed, a lot of construction. We also, the chart I didn't put in here is lumber prices have been fickle at best, but they pulled up. The futures look like they're going to pull back, but prices to build anything have kind of gone out the window, or gone through the roof, if you want to say. But if you look at it on long-term rates, an $80,000 family wage earner, typically, they could afford a $2,000 a month house payment. At year-end 2018, mortgage rates, if you can see there, mortgage rates were, low to mid fours. That would be a $392,000 house. At year-end 2020, using the exact same variables, you've got the same car payments, you got the same everything, you haven't had a COVID baby or anything yet, you could buy a $495,000 house strictly due to the rate reduction environment. So that has, in my opinion, fueled a whole lot of the economy. But we also had a lot of things change in Northwest Arkansas. Is there were a lot of developments that were in preparation late 19, early 20 that got delayed. So the availability of lots for the home builders also got a little skewed, that they did not come online near as quick as they thought. So we might have had a few houses that would have sold out in earlier 2020, but then the labor market, I know a couple of projects that totally shut down because COVID, they ended up infecting the project. So the commercial project shut down for 2 weeks. Outside of those are very short term, they're very real, but outside of those, I think you have to look at is we had a lot of widgets that people wanted to buy. They were still employed. They had still, some of them had received stimulus, but they had money, they're ready to do it, and they're ready to capture this mid-2 rate. But you have to look at this, that is 2%. That's about a 45% reduction in rate over 24 months. So the one thing I caution people, or I'll go to here, was pre-COVID, your life of loan would have cost you $500,000. During COVID, you would have saved about $60,000. So pre-COVID, how much can I buy? $300,000. During COVID, 350,000. And I say during COVID as we are right now. I really wanted to do that post-COVID, but I scared Dr. Joe would come off of mute. But because we're still in it, guys, we still see it in the business community every day. We were just on a call this morning talking about if snow hits, New York got 2 inches or 24 inches of snow last week, and Florida, they said, that's okay, we got 12 hours of sunshine. But in Arkansas, if snow hits, do we close branches? Well, we've never had the discussion of do we close branches because we don't have the manpower, the healthy manpower to open up. That is what COVID has done to small businesses in addition to just the overall economic.
Yeah.
So yeah. I'm going to let that set there. I know there's only a few ladies on there. Let me turn this off.
Well done.
Yeah, let me get back off of here. Thank you.
Scott, yeah, go ahead.
Let me a couple things is the thing that has happened when home buyers is, and I take this into a context of the high wage earner, is they go from a $200,000 house, I'm not going to say during med school, but maybe it's during med school or, school, they go to a $400,000 house, and then all of a sudden they jump up to a $700,000 house. And the one thing, or multiple things that we forget are home maintenance. I used to be able to mow my yard. Now I've got to hire a landscape crew because I can't spend the hours to mow it. So upkeep. And then the other thing is a lot of times that buyer, these low rates, they also have 1 car, 2 cars. In my case, I have a 4-month driver. So I have 3 cars, but I have to have the date car and the boat. And those are the things when rates tick back up and we have to buy another large purchase, whether it be a house or whatever, how is that going to affect the rates being down are almost another revenue stream, if you want to look at it like that. So if we're not cautious, rates being down are considered a revenue stream, just like some people use credit cards. Is I don't have the money to buy it. Credit cards should be a convenience tool, but people use them and they go, well, I'll pay part of it off in 30 days. So I think we need to look at prime rate, like I said, has dropped from 5.5 to 3.25 in the same kind of time frame or in 2-year time frame. The 3-month T-bill, which is a lot of short-term borrowings, a lot of people talk about our Fed funds, has gone from 2.4 down to 0.02 or Fed funds 0.07. So us as banks, we've got all this stimulus money, we've got the PPP loans that people haven't spent. Banks have a tremendous amount of liquidity, and we don't have anywhere to go with it because we're only getting paid 0.07 overnight funds. And so locally, we're trying to help our customers and give them money, the fixed income people, the CD people, but we can't go out there and grab the ability. There's no way we can pay 1% on money. You'd have to go to a 10-year product right now to get 1% on your money. Mm-hmm. So, any questions?
Scott, would you also agree with the fact that, well, the big risk is that we have inflation and interest rates start going up, and we're used to this. This is like a huge stimulus. We can purchase larger homes, but we also have to remember on the downturn, should rates go up, you got a lot less buyers for those larger homes, right? So they're pretty illiquid. As you go up that, you got a more illiquid home probably, categorically. And then on the commercial real estate, those aren't fixed rate loans, are they? So you've got the more variable rate risk in the commercial than you would have in the home.
And that's a little bit of the point that I was bringing out is, most of the banks locally will go 3 to 5 years on a balloon. It's not an arm, it's not on a balloon. And so if you have a 2% adjustment, you're going to have a 15% payment increase. The other thing, as you mentioned, is inflation. A lot of people say, I think inflation's out there a long time. I think we do have to look at Yellen. Last time she was in office or in her position, whether she was a chairman or assistant chairman, pushed rates up. And so I think we'll see that. Again, my personal opinion, how long? But when you have this much stimulus money in the economy, it has to drive. I mean, just look at 6 months ago. How much was gas compared to now? What, I mean, production really hadn't changed. I mean, there's always those things that you can go, well, we had this. But I will say, just from Scott Hancock and Centennial Bank, we've had hurricanes hit Florida. We've had tornadoes hit Arkansas. And every business that's on the call they've all had isolated effects. But this is the first time that I think we have seen a medical and an economic crisis simultaneous. And I think all this stimulus plan is going to lead to some inflation that, yes, we have to, and some inflation is not necessarily bad, in my opinion.
Right. Yeah, a little of it. Yeah. Yes, sir, Dr. Joe.
Scott, thank you. I'm getting out of my lane, so I apologize if this doesn't make any sense, but are you seeing, a lot of commercial entities that didn't have publicly facing requirements have operated differently in the last 12 months, working from home? Do you see the commercial property having less demand going forward because we work in a different way than we did before, having discovered that we don't have to go to the office to get the same amount of work done?
I'll answer that two ways. One is we haven't seen the effects yet because there are a lot of leases in place.
Okay.
Still might have 2 years, 3 years, 5 years leases in place. We are seeing, and even some discussions in Northwest Arkansas of people that they had a 70-person team, 20 of them need to be in the office staggered. So, hey, we've got, I'm going to call it 10,000 square feet. When our lease comes up 3, 5, 7 years, unless things change, which put that out here, we think we might only need 4,000 square feet. So I think we will see that, but I think it'll be rolling. The other thing, which I'll kick back to you pretty much is, and I say this, we have a lady in finance here that I visit with a lot. She lives in Conway. She's single. She has a dog. And so I said, how are you doing? She goes, the first 2 weeks, it was great. Our reports are downloaded at 5:30. I can get up, I can get them done. I beat everybody to the reports, the CEO, everybody has their reports versus I got to wait on somebody at 8 o'clock, blah, blah, blah. And she says, the first 2 weeks are great. I got up, I brushed my teeth, I kept on the same pajamas. After about 2 weeks, I kicked my dog twice. I used to enjoy walking, but then I kept having these problems. And after about 2 months, I called in and said, can everybody leave the office so I can go in? Mm-hmm. So the mental health and the interaction is really going to try, which could reverse that, Dr. Joe, in my opinion. Yep. It could reverse some of that commercial. Everybody's going, hey, we're going to scale back. We are seeing back on the home level, we're seeing some changes. And I think that's another impetus of people buying more houses is they're changing because all of a sudden they converted something to a home office and they're like, hey, we need a different houses. So I think we'll see home builders, as I joke, the home builders that build in Northwest Arkansas, they don't have to have a screened-in patio, but if they move to the Northeast Arkansas, they better have a screened-in patio plan because they have, mosquito areas. Same thing is now you need to put a home office in your plan, different technologies, different things like that.
Yeah, great point. Great point. Tommy Van Zandt, would you like to comment on the office sector? You're available. And then Stuart Nance, would you like to comment on well, Tommy maybe gets ready. Stuart, would you like to comment on how small business and what you're seeing? Stuart's a business broker, is in the trenches a lot. Tommy's available now. Thanks, Stuart. Why don't you go next? Tommy?
Yeah, I was talking to Tom Allen this morning. We had a kind of our monthly broker call within our company, and Tom Allen at Pinnacle has seen a few tenants, probably 5 or 6 that have, and I'm talking office, that have come and asked for some form of rent reduction, et cetera, restructuring. And depending on the tenant, who they are and that type of thing, they're working with them very creatively on restructuring their lease rates and extending their leases, et cetera. He did mention that some of the tenants they had given some relief to, probably, back in, I don't know, April or May, had already come back and paid back what they owed and are back on track. So I think we're seeing a little bit of a return to normalcy, at least in Benton County. Um, I would say that Washington County is a little tougher because you don't have as many institutional grade
Tenants.
companies
Yeah.
down there.
Yeah.
So in the retail, as we all know, the retail side is just, hurting pretty bad, but there are a few bright spots. And I think, if we can get, and I don't want to step on Dr. Joe's knowledge here, but if we could get, uh, if the vaccines come out in the numbers they're talking about, and we're able to get them in arms, maybe in the fall, we can look toward more capacity in restaurants and people more willing to get out. I think everybody's dying to get out and go to restaurants and go to their favorite little store, locally owned stores,
Yeah.
etc.
Yeah.
So
Yeah.
that's what I see.
A lot of pent up demand in the consumer market as soon as we open this economy more, I think. Ed Nicholson believes that, I know a lot.
Travel in particular. So that should start to help hotels and airlines and all of that.
Yeah, for sure. Stuart Dance, you want to comment on the strength of your sector where you're buying and selling businesses for people?
Sure. Echoing some of what Scott's saying, the PPP loans helped businesses a lot last year, restaurants in particular. I've got several restaurants that have sold earlier in 2020, Bordino's, that has been very active utilizing some of the SBA options of financing. And I think it's going to be important again this year. But restaurants have been hit hard, but there's other segments of industry in Northwest Arkansas, Main Street, kind of hospitality oriented, that we've seen pockets of strength, but we've had poor responses from the financing side. Honestly, I've got several resorts for sale that are doing better performance than they ever have, but the SBA and or the local banks that they work through have shown a reluctance to look at hospitality.
Yeah. Okay. We lose you?
Industry,
There you go.
tough industry, but there are segments that are exceptions to.
Well, you there, Stu? We might have lost you on that last part. You calling from Eureka, I bet, on the lakeside. Okay.
Yeah, I don't have the strongest signal out here. Can you hear me now?
Yeah.
Okay. But overall, there's the business brokerage business. There's a lot of people that this has kind of awakened them to. It's time to consider retiring. So it's an active market for business sales.
Yeah.
And the banks and SBA incentives that are out there are really couldn't, and lower interest rates. There couldn't be a better time to buy a business. If really time to buy a business.
Yeah. Thank you, Stuart. Very well put. Scott, back to you. you want to wrap us up?
Yeah, I would say thank you. I again go back to my last slide is for all the guys on the call, you're welcome for the reminder that Valentine's Day is this weekend. For all the ladies on the call, happy Valentine's Day. But I will still say is just as Stuart said, is it is a great time. There are some mergers and acquisitions going on. And I can't reiterate enough. Well, the other thing I'll say is we had one particular customer that in April, I believe, said, I think I might have to close. And we were just talking, said, have you thought about this? Have you thought about this? And by October, they were up 2% year over year because they changed to meet the consumer. We can't do it. The positive that this will change is all of us. I hate being on here. I hate being on camera. I'm always off camera. It's because Diane was supposed to send me some powder and it didn't work. But here we do it. We all have to change and we all have to adapt. And we've taken that for granted. We have to do that. But we're all one big team. And Northwest Arkansas is a bit of a microcosm of the rest of the world, but there are a whole lot of positive things. The incentive, the live work here incentive of $10,000. There's a lot of things out there that set us apart, but it's a health thing. And somebody told me is if you look on a lot of doors and you see no shoes, no shirt, no service, you don't complain about it all. If they added no mask, fine. Still go in there and shop, just wear a mask on. You know, if that's what we are. But I would never think about going in somewhere. And there's some comedians out there that said, you know, if they ask you to wear pants, wear pants. If they ask you to wear a mask, whatever, but that will help our local economy get back.
You bet. That's well said, Scott. Thank you. Well done.
Did I mention buy local?
You did mention buy local. Steve McBee did some chatting you up on that. Do good, shop local, Steve McBee says. And let me come back to one more thing. And you're right, we were very fortunate to be in Northwest Arkansas. We're 32 people moving here net of in-migration, out-migration, net 32 people a day, according to Malone and his stuff. And but Ed Nicholson, you're keenly aware of the state legislation. Dr. Joe mentioned earlier, and what happened, what was it, North Carolina that didn't get some bills passed and the state just didn't look good and they started blackballing some people, some larger companies.
Yeah, Georgia has lost a lot of business, particularly they had a lot of film industry that they lost.
Yeah, having to do with just not
can have
being,
an effect.
Just due to state legislation, right? That they're just kind of not very smart. So don't not be engaged in that if y'all want to not hurt our economy. There's some laws that don't need to be passed. There's some that do need to be passed. And the Northwest Arkansas Council has a good angle on that, on what we should be encouraged to do and what not to do. And Dr. Joe brought up some good ones there. So thank you for that, Dr. Joe. Anything else? Anybody, any questions for Scott or anything else y'all like to cover? It's time to go eat, isn't it? So hope you all have a good lunch and good to be with you. And hope you learned some things. It's very insightful for me. I hope it was for you. We'll record this and put it on our YouTube channel. And do think about the Arkansas Community Foundation and that event. That they're about as classy as there is anywhere. Obviously, they have Jody on their team. They got to be great. And happy Valentine's Day to Jody and Shannon and everyone. And appreciate you all being here.